Listen carefully, because I'm about to show you something different. Forget penny stocks for a moment. What if I told you the real wealth is built with quality companies at the right price? I've got three stocks, $70, $97, and $532 that represent the future of warehouse automation, medical innovation, and aerospace technology. These are real companies with real profits building real wealth for shareholders. Hey everyone, welcome back. Today we're talking quality growth investing. This isn't financial advice, do your research, but if you're ready to invest like the pros, let's dive in. Before we jump into these quality stocks, quick challenge. If this video can hit 50 likes, I'll know you want more analysis on high-quality growth companies like these. So smash that like button right now. Let's hit 50 likes together. Our first stock is Symbotic, ticker SYM, trading at $70.45 per share. Symbotic is revolutionizing warehouse automation with AI-powered robotics, and they're doing it at a scale that's absolutely mind-blowing. Symbotic designs, builds, and deploys fully automated warehouse systems using artificial intelligence and robotics. Imagine a warehouse where robots handle everything: receiving, storing, picking, and shipping with minimal human intervention. Their system uses autonomous mobile robots, sophisticated software, and AI to optimize the entire warehouse operation. Here's what makes Symbotic special. Their biggest customer is Walmart. Yes, Walmart. Walmart is deploying Symbotic systems across their distribution network because the efficiency gains are massive. Faster fulfillment, lower labor costs, fewer errors, better inventory management. Symbotic's technology transforms distribution centers into highly efficient automated facilities. But it's not just Walmart anymore. Symbotic is expanding to other major retailers and distribution companies. Target has announced they're implementing Symbotic systems. Other large retailers are evaluating the technology. As e-commerce grows and labor costs increase, warehouse automation isn't optional, it's essential for survival. The total addressable market is enormous. There are thousands of large distribution centers across retail, grocery, pharmaceutical, and industrial sectors that could benefit from automation. Symbotic is still early in their penetration of this massive market. Financially, Symbotic is growing revenue rapidly as they deploy more systems. Each warehouse system represents a multi-million-dollar contract plus ongoing software and maintenance revenue. They're approaching profitability as they scale, and their backlog of orders continues growing. At $70.45, Symbotic isn't cheap on traditional valuation metrics, but you're paying for revolutionary technology with a massive addressable market and proven customer validation. If automation becomes standard across distribution, and it will, Symbotic is positioned to be the dominant player. My price target for 2025 is $95 to $110, representing about 35 to 55% upside. Long-term, if they capture significant market share, this stock could be $150 plus in 3 to 5 years. This is a quality growth stock for patient investors betting on the automation revolution. Moving to our second stock, Boston Scientific Corporation, ticker BSX, at $97.79 per share. Boston Scientific is one of the world's leading medical device companies, and they've been absolutely crushing it with consistent execution quarter after quarter. Boston Scientific develops and manufactures medical devices used in interventional medical procedures. We're talking about cardiovascular devices like stents and catheters, electrophysiology systems for treating heart rhythm disorders, devices for peripheral interventions, neuromodulation systems for pain and movement disorders, and endoscopy equipment for minimally invasive procedures. Here's what's exciting about Boston Scientific. They're in multiple high-growth medical device categories. Cardiovascular procedures continue growing as populations age and treatment rates improve globally. Electrophysiology is booming with AFib treatments becoming more common and less invasive. Their neuromodulation business addresses chronic pain and neurological conditions affecting millions. The company has a robust innovation pipeline with new products launching regularly. They invest heavily in R&D, acquiring innovative technologies and developing next-generation devices. Their Watchman device for stroke prevention in AFib patients is a massive success. Their pulsed field ablation technology for treating AFib is revolutionary. They're consistently winning market share across categories. Boston Scientific operates in markets with favorable demographics and secular growth trends. Aging populations mean more cardiovascular disease, more heart procedures, more interventions. Obesity epidemic means more diabetes, more vascular complications, more device needs. These aren't cyclical trends, these are long-term secular growth drivers. Financially, Boston Scientific delivers consistent revenue growth in the high single digits, expanding margins, and strong cash flow generation. They've been beating earnings estimates consistently. Management executes well, allocates capital intelligently, and continues taking market share from competitors. At $97.79, Boston Scientific trades at a premium valuation, but it's justified by their growth, execution, and market position. This is a quality healthcare stock that's compounded wealth for shareholders over years. My 2025 price target is $115 to $125, representing about 18 to 28% upside. But honestly, this is a buy and hold forever type stock. If you own Boston Scientific for 5 to 10 years, you're betting on consistent execution, innovative medical devices, and aging demographics, both very safe bets. This is the type of stock serious investors accumulate and hold. And finally, our third stock is Teledyne Technologies, ticker TDY, at $532.73 per share. Yes, over $500 per share, but don't let the price scare you. Teledyne is a diversified industrial and technology powerhouse that's been quietly compounding wealth for decades. Teledyne operates across multiple segments: digital imaging, which makes cameras, sensors, and imaging systems for industrial, scientific, aerospace, and defense applications; instrumentation, providing electronic test and measurement equipment, environmental monitoring, and marine technology; aerospace and defense electronics, supplying components and systems for commercial aviation, defense, and space; and engineered systems, manufacturing highly engineered products for aerospace, defense, and energy markets. What makes Teledyne special is their diversification and quality. They're not dependent on any single market or customer. They serve commercial aviation, government defense, industrial automation, scientific research, environmental monitoring, healthcare, and more. This diversification provides stability while still offering growth. Teledyne has an exceptional track record of value-creating acquisitions. They identify niche, high-quality, niche businesses with strong margins and sustainable competitive positions, acquire them at reasonable prices, and integrate them successfully. This acquisition strategy has driven consistent earnings growth and margin expansion over time. The company benefits from multiple secular growth trends. Defense spending is increasing globally, Teledyne wins. Commercial aerospace is recovering, Teledyne wins. Industrial automation is growing, Teledyne wins. Environmental regulations are tightening, requiring more monitoring equipment, Teledyne wins. Space economy is expanding, Teledyne wins. They're positioned across multiple growth vectors. Financially, Teledyne is a cash-generating machine. They have strong margins, excellent returns on capital, minimal debt, and consistent free cash flow. Management is shareholder-friendly, disciplined about capital allocation, and focused on long-term value creation rather than quarterly gains.
At $532.73, Teledyne is expensive per share, but actually reasonably valued on earnings. They trade about 25 to 27 times earnings, which is fair for a high-quality, diversified industrial technology company growing mid-single digits organically, plus acquisition growth. My 2025 price target is $585 to $625, representing about 10 to 17% upside. But like Boston Scientific, Teledyne is a compounding machine. Hold it for 5 to 10 years, and you're betting on consistent execution, smart acquisitions, and diversified exposure to multiple growth markets. This is a true quality stock for serious long-term investors who understand that great companies at fair prices beat cheap companies at any price. So there you have it, 3 quality growth stocks across 3 completely different sectors. Symbotic revolutionizing warehouse automation at $70, Boston Scientific dominating medical devices at $97, and
Teledyne compounding across multiple markets at $532. Here's what these 3 have in common. They're real businesses with proven management, competitive moats, strong financials, and secular growth tailwinds. These aren't speculative penny stocks. These are the types of companies that build generational wealth. I want to be clear about my investment philosophy. I'm not against speculative plays, but the core of any portfolio should be quality companies. Symbotic, Boston Scientific, and Teledyne represent that quality. Yes, they require more capital. Yes, the percentage gains might be smaller than a penny stock that 10x's, but the probability of success is exponentially higher. My personal approach? I'd build positions across all 3 for diversification. Symbotic for automation exposure and highest growth, Boston Scientific for healthcare and consistent execution, Teledyne for diversified industrial technology and stability. Together, they provide excellent sector diversification while maintaining focus on quality. So here's my question. Which of these 3 quality stocks resonates most with you? Are you drawn to Symbotic's revolutionary automation, Boston Scientific's medical innovation, or Teledyne's diversified excellence? And honestly, are you ready to invest in quality over cheap prices? Drop a comment and let me know your thoughts. Did we hit that 50-like goal? Let's check. If we did, you're absolutely amazing. If we're close, hit that button right now. Subscribe for more quality stock analysis and share this with serious investors who value fundamentals over hype. Remember, wealth is built with quality companies held over time. These aren't trades, these are investments. Do your research, understand what you own, and invest for the long term. Thank you for watching. I'll see you in the next one. Now go build your quality portfolio. Peace.